In 2015, a shockwave of unprecedented magnitude reverberated through corporate Japan. Not from an earthquake, a common threat in the region, but from Toshiba's stunning admission of a staggering $1.2 billion accounting fraud. The revelation sent tremors throughout the global financial markets. For 7 long years, profits were systematically and meticulously inflated, not by accident or oversight, but by a deliberate and calculated deception orchestrated from the very top echelons of the company. This wasn't a simple error, it was a carefully constructed illusion. The revelation shattered the long-held trust in a company once universally seen as a cornerstone and a pillar of Japanese industry, a symbol of national pride, and a global leader in innovation. Toshiba's reputation, built over decades, was suddenly in tatters. What began as a seemingly minor internal probe quickly exposed a deeply ingrained culture, a rot that had festered for years, where meeting impossible and unrealistic profit targets, referred to internally as the challenge, became not just a goal, but a ruthless and unforgiving command, enforced through immense pressure and fear of failure. Top executives, including 3 former presidents who had once led the company with prestige, were directly implicated in a complex web of premature profit booking, a deceptive practice designed to artificially inflate earnings, hidden losses, concealed from investors and regulators alike, and deferred costs, pushing expenses into the future to create a false picture of current financial health. The scandal exposed not just individual acts of wrongdoing, but a systemic and catastrophic failure of oversight at nearly every level of the organization. By the board of directors, who were meant to provide guidance and accountability, the audit committee, responsible for ensuring financial integrity, and even the external auditors, whose job it was to independently verify the company's financial statements. Toshiba's celebrated legacy of innovation, a history of technological breakthroughs and market leadership, was abruptly replaced overnight by a stark symbol of corporate decay and ethical bankruptcy. The world watched with a mixture of disbelief and condemnation as the company's once pristine and unblemished image crumbled before their eyes, revealing a deeply flawed culture where questioning authority was considered taboo, dissent was stifled, and ethical lines were not just blurred but completely erased in the relentless pursuit of profit. The dramatic fall of Toshiba forced Japan, and indeed the entire world, to confront the inherent dangers of unchecked authority, the perils of prioritizing conformity over critical thinking, and the devastating true cost of prioritizing short-term results and financial gains over long-term sustainability and unwavering integrity. It was a catastrophic fall from grace, a cautionary tale that would forever change the global conversation about corporate governance, business ethics, and the fundamental importance of accountability. To truly grasp the magnitude of Toshiba's fall, a decline that reverberated through the global tech landscape, we must first remember its meteoric rise, a journey fueled by innovation and national pride. Born from the ambitious 1939 merger of 2 pioneering firms, each a leader in their respective fields, Toshiba rapidly ascended to become a powerful symbol of Japan's post-war ambition, its relentless drive for reconstruction, and its unwavering commitment to technological leadership on the world stage. The company's groundbreaking innovations were nothing short of legendary, shaping industries and transforming daily life. From developing Japan's first radar system, a critical advancement in defense technology, to introducing the world's first mass-market laptop, a portable computing revolution that changed how we work and connect, and pioneering the invention of NAND flash memory, a ubiquitous technology that powers countless devices today. Its expansive reach spanned a diverse array of sectors, from consumer electronics that filled homes with entertainment and convenience, to the complex and critical field of nuclear power, contributing to the nation's energy infrastructure, medical imaging, providing cutting-edge diagnostic tools for healthcare professionals, and the intricate world of semiconductors, the building blocks of modern technology. For generations of Japanese workers, securing a job at Toshiba meant more than just employment. It represented prestige, stability, and long-term security, a powerful testament to the enduring Japanese model of lifetime employment, fostering unwavering corporate loyalty and a strong sense of belonging. Its influential leaders played a significant role in shaping national policy, contributing to Japan's economic and industrial strategies, and its globally recognized brand was synonymous with exceptional quality, unwavering reliability, and cutting-edge innovation. But this towering legacy, built on decades of success and innovation, inadvertently created immense pressure, an unspoken burden, to perpetually maintain an unbroken chain of success, a relentless pursuit of growth and profitability. The perceived need to project an image of unwavering strength and invincibility gradually became a heavy burden, making transparency and honesty increasingly difficult, especially as expectations from shareholders and the public soared to unprecedented heights. The very history that propelled Toshiba to greatness, the foundation upon which its empire was built, also, tragically, sowed the insidious seeds of its eventual downfall, a slow and painful decline from grace. When the overwhelming pressure to uphold its carefully crafted image and meet unrealistic targets ultimately outweighed the fundamental duty to be honest and transparent, the stage was irrevocably set for a devastating disaster, a corporate tragedy of epic proportions. Toshiba's cautionary story serves as a stark reminder to us all that even the mightiest and most revered institutions can ultimately fall when hubris and the relentless pursuit of profit eclipse the unwavering principles of integrity and ethical conduct. The roots of Toshiba's fraud lay in the aftermath of the 2008 financial crisis and the 2011 Fukushima disaster. With profits plunging and a disastrous bet on nuclear power, leadership doubled down instead of recalibrating. The challenge, impossibly high profit targets, became non-negotiable commands. Fear replaced transparency, bad news was buried, and creative accounting became survival. Division heads, squeezed by shrinking margins and failed investments, resorted to inflating numbers to mask reality. The acquisition of Westinghouse, once hailed as visionary, became a financial albatross. Refusing to write down losses, Toshiba's leadership propped up a crumbling facade. The culture of loyalty and perseverance was twisted into a tool for deception. In the end, the fraud was a desperate attempt to hide the cracks in a once mighty empire. Toshiba's fraud wasn't a mere oversight or a series of isolated incidents. It was a meticulously coordinated, company-wide effort, deeply embedded within the corporate culture. It wasn't just a few rogue employees acting alone. It was a systemic issue that permeated every level of the organization. Managers, under immense pressure to meet targets, resorted to manipulating percentage of completion accounting. They achieved this by brazenly exaggerating project progress, painting a rosy picture of advancements that were far from reality. Simultaneously, they were adept at hiding costs, effectively sweeping them under the rug to artificially inflate profits and pull future earnings into the present, creating a false sense of financial well-being. Losses and expenses, instead of being promptly recorded, were deliberately delayed, postponed to future reporting periods. Meanwhile, obsolete inventory, gathering dust in warehouses and long past its sell-by date, was stubbornly kept on the books at inflated values. And to further distort the financial picture, costs were cleverly disguised as assets, artificially boosting the company's net worth on paper. Each quarter, the relentless pressure from the top echelons of management triggered a frantic, almost desperate search for discretionary efforts. This was simply a code word for bending the rules, pushing the boundaries of ethical conduct, and engaging in practices that were, at best, questionable. Internal controls, designed to safeguard the company's assets and ensure the integrity of financial reporting, were systematically ignored. The entire system, corrupted from within, normalized profit inflation as standard operating procedure, an accepted, albeit unethical practice. What began as seemingly small, insignificant adjustments, perhaps intended as temporary measures, quickly snowballed into a full-blown financial illusion, a house of cards built on deception. The fraud became self-perpetuating, a vicious cycle of deceit. Once profits were artificially inflated, The next quarter demanded even bigger lies, more elaborate schemes to maintain the illusion of success. The gap between the reported results, the figures presented to the public, and the underlying reality grew wider and wider until it reached a point where it could no longer be concealed, where the truth threatened to burst forth. It was, in effect, a corporate Ponzi scheme, a system that relied on ever-increasing levels of deception to sustain itself, and therefore destined to collapse under its own weight. The truth, as it always does, was inevitable. Sooner or later, the numbers simply wouldn't add up. The discrepancies would become too glaring to ignore, and the carefully constructed facade would crumble. The unraveling began with a single act of courage. In 2015, a Toshiba finance employee sent an anonymous, detailed tip to Japan's Securities and Exchange Surveillance Commission. In a culture where whistleblowing is seen as betrayal, this was a profound risk. The tip forced regulators to act, bypassing Toshiba's corrupted internal channels. An independent investigation was launched, led by outsiders with a mandate to uncover the truth. Investigators interviewed hundreds, sifted through emails, and pieced together 7 years of deception. The final report was damning. The fraud was systematic, deliberate, and sanctioned by top management. One insider's courage brought a giant to its knees and exposed the rot at its core. Sometimes it takes just one voice to break the silence. The independent report's release in July 2015 was catastrophic for Toshiba. Top management, including 3 presidents, resigned in disgrace, bowing deeply in public apology. 8 board members stepped down. The company restated 7 years of earnings, erasing a third of its claimed profits. Toshiba's stock value plummeted by over 40%, and it was placed on a special watch list, facing possible delisting. Investors were furious, lawsuits mounted, and the company's credibility was shattered. The Westinghouse acquisition's true cost emerged, forcing multi-billion-dollar write-downs and pushing Toshiba to the brink of insolvency. To survive, Toshiba sold off its prized memory chip and medical businesses. The once mighty conglomerate was dismantled, a shadow of its former self. All of it traced back to years of hubris, deception, and a culture that punished honesty. The collapse was total and irreversible. At the heart of the scandal was a culture that prized loyalty and obedience above all else. Challenging superiors was unthinkable. Dissent meant risking your career and reputation. Lifetime employment fostered conformity, making silence the safest option. Leaders ruled by decree, demanding results and punishing failure. Internal checks and balances were neutered. Finance and audit teams became complicit. The audit committee lacked authority, and the culture of deference silenced whistleblowers. Loyalty, once a virtue, became a tool for perpetuating wrongdoing. Without accountability, even the most loyal workforce can become complicit in disaster. Regulators responded quickly, but critics argued the penalties were too light. Toshiba was fined a record 7.37 billion yen, about $60 million, far less than the fraud's scale. The scandal became a catalyst for sweeping governance reforms in Japan. New rules required more independent directors, stronger audit committees, and better shareholder dialogue. Toshiba's auditors, Ernst & Young Shinihon, were fined and suspended for failing to detect the fraud. The company overhauled its board, bringing in outside directors and empowering its audit committee. Internal controls were strengthened, and a new culture of transparency was promised. The reckoning forced Toshiba and Japan to begin rebuilding trust from the ground up. Toshiba's collapse offers universal lessons for companies everywhere. The danger of unchecked CEOs and passive boards is clear. Real independence means challenging management, not rubber-stamping decisions. Prioritizing short-term results over long-term health leads to disaster, a lesson not unique to Japan. Robust internal controls and empowered compliance teams are essential. They must have direct access to independent board members. Compliance can't be a checkbox. It must be a living, enforced value. Whistleblowers are vital. Their protection is the first line of defense against misconduct. Companies must foster a culture where speaking up is valued, not punished. The Toshiba case is a warning. Without integrity, even the strongest organizations can crumble. These aren't just lessons for avoiding scandal. They're the foundation of sustainable, trustworthy businesses. The world is watching. The stakes are higher than ever. Toshiba's fall was a turning point for Japan and a global wake-up call. The scandal accelerated governance reforms, pushing board independence and transparency to the forefront. Yet changing deep-rooted culture is slow. The real test will come in the next crisis. Ethical leadership remains the bedrock of sustainable success. Regulations alone aren't enough. When leaders set the right tone, organizations can withstand pressure without sacrificing principles. Toshiba's journey back is ongoing, a humbling reminder of the cost of lost trust. Its story endures as a cautionary tale and a beacon for a new era of corporate governance.